All right, let's talk stock options. I know, just the word can sound super complicated, right? But what if I told you we could boil it all down to a simple game, one with a clear blueprint you can actually follow? Well, that's exactly what we're going to do. Let's dive in. So yeah, let's just reframe this whole thing. Forget about it being some kind of impossible financial puzzle. I want you to think about stock options as a simple game with a game plan. And that's our whole mission here, to hand you that game plan. Okay, first things first. Every game has rules, right? So let's lay out the rules for ours. And don't worry, we're going to ditch all that intimidating Wall Street jargon. Just think of this as a strategy game, pure and simple. So what is an option, really? At its absolute core, it's just a prediction. That's it. It's you making a bet on which way you think a stock's price is going to go. See, you're not buying the stock itself. You're buying the right to trade it at a set price down the road. That's the fundamental piece on our game board. And you know what's great about this game? There are really only two main moves you can make. It's simple. You're either betting the stock's going to go up, or you're betting it's going to go down. Naturally, these two moves have names. If you're optimistic, if you think the price is heading up, you buy what's called a call option. And if you're pessimistic, thinking it's going down, you get a put option. Now, for the blueprint we're building today, we are going to focus entirely on the call option. This is going to be our go-to power move for betting on a great company's big comeback. Okay, so no game is played in a total vacuum, right? There's always some external factor you got to deal with. In the options game, that big, unavoidable force is time. And honestly, the best way I've ever heard it explained is to think of it like a melting ice cube. Now, this melting has a fancy name, of course. It's called theta. But don't let that spook you. All it means is it's a way to measure how much value your option, your prediction, is losing day by day, just because time is ticking away. It's like the game clock, and it is always running. So let's stick with our ice cube. If you buy an option with a ton of time left before it expires, say 6 months, maybe even a year, that ice cube is huge and it's melting really slowly. Time isn't a big deal yet. You've got this nice, solid block to work with. But, and this is a huge but, as you get closer and closer to that expiration date, that ice cube starts to melt fast. I mean, really fast. In the last few weeks or even days, the value can just poof, evaporate. This is so important to understand because it completely changes the type of companies we can use for our strategy. So, the big question is, how do you beat a melting ice cube? Well, you have to bet on something that has a really good chance of heating back up before your ice cube is gone. And this leads us to the number one most important rule of this whole game. You only play with quality companies. I'm talking solid financials, companies that are fast movers and have a track record of recovering well after a dip. This strategy is a no-go for those crazy meme stocks, and it's also not great for the slow, sleepy giants. You need companies that the market believes in, companies that have earned the reputation for bouncing back. All right, now we're getting to the real meat of the strategy. This is what I call the 52-week high plan, and it's all about finding that perfect moment to make your move. And here's the kicker. We're not going to base it on hype or what's trending. We're going to base it on history. So let's paint a picture. Our story starts right here. Imagine one of those great companies we talked about just hit a new 52-week high of, let's say, $100 a share. This is the peak, the top of the mountain. Everybody's thrilled. But what do? We do absolutely nothing. We don't buy at the top. We just sit back and wait. Because we're waiting for the market to do what it almost always does eventually. It overreacts. Our whole plan only kicks into gear when that stock pulls back, somewhere in the neighborhood of 20%. And usually, this kind of drop is because of some short-term panic, not because something is fundamentally wrong with the company. Okay, so a 20% drop from $100 brings the stock price all the way down to $80. Now, for most people, that looks like a disaster. But for us, no way. This is our opportunity. This is the zone where we start paying very close attention. But here is the absolute key to this whole thing. We are not betting that the stock is going to rocket all the way back up to $100. That's a tough bet. Instead, we're making a much more conservative, a much higher probability bet. We're going to buy a call option that's just about 10% above this new lower price. So with the stock sitting at 80, we're going to target a $90 call option. Okay, let's lay it all out step by step. Step 1, you make your list of 10 to 20 rock-solid quality companies. Step 2, you jot down their 52-week highs. Step 3, you wait. You patiently wait for that 15 to 25% pullback.
Step 4, the moment it hits that zone, you buy your call option, the one that's about 10% higher than the current price. And step 5, this is absolutely critical. You make sure that option has at least 6 months of time on it. Why? Because that's how you fight back against that melting ice cube. You're buying yourself time.
All right, we've got all the pieces on the board. Now we can put them together to see the final blueprint. And I'm even going to throw in one more, slightly more advanced move for those times when things don't go exactly to plan right off the bat. I mean, this is the question that keeps people up at night, right? What happens if you do everything right? You buy your $90 call when the stock's at 80, and then it just keeps dropping. What do? Do you panic? Sell everything? Nope. You don't panic because you've got a plan for that too. It's called adding a leg. It's simple. If the stock drops again, let's say it goes from 80 down to 70, you just run the play again. You buy a second call option, this time targeting 10% above 70, which would be an $80 call. What you're doing here is brilliant, actually. You're lowering your average entry point, and you're giving yourself two separate chances, two different price levels, for the stock to recover and make you a profit. And there you have it. That's the full blueprint from A to Z. You start with great companies the market trusts, you use patience to wait for a market overreaction, you make a smart, conservative bet, not a wild guess, and you always give yourself plenty of time. That 6 months is your shield against that melting ice cube. It lets the quality of your company do the heavy lifting for you. And if the stock dips again, well, now you've even got a plan for that. When you really boil it all down, the whole strategy comes back to one core idea. You're not trying to be a genius who perfectly times the market. You're not trying to get rich by next Tuesday. All you're doing is using two incredibly powerful forces to your advantage: the market's tendency for short-term panic and a great company's ability for long-term recovery. So, that's the game plan. A simple, structured way to think about and use stock options. Now you've got the blueprint, so the real question becomes, what's the first quality company you're going to start watching? What's the first move you'd start to map out?